Good afternoon, I'm Jennifer Christian and I work as a portfolio specialist in the investment management team, and I'm going to provide you with a brief overview of this week's market summary. Following last week's eventful ending, this week has seen the fading reaction of US President Donald Trump's tariff threats and the US Federal Reserve rate cut. Whilst the overspill from Trump's tariff announcement dragged on markets early on in the week, following the threat of Chinese retaliation, we saw a bounce back in the second part of the week. Sentiment pressured markets early on, and we also saw the People's Bank of China set their currency at a stronger than expected rate in order to support the currency. So whilst it feels like we are back to square one with China ceasing their purchase of US agriculture goods and the US threatening tariffs, not a lot has changed in the negotiation tactics of both nations. And even though this is a source of frustration for the markets, which can of course cause worry, it is important to remember that it is this noise-driven volatility that presents opportunities. Arguably the most significant data set this week was the release of Chinese trade data, which came in considerably stronger than anticipated, seeing exports grow by 3.3%, which was 4.3% greater than expected. In addition, imports came in at minus 5.6%, which was 3.4% greater than expected. This data is significant given the US-China trade rhetoric at present, suggesting that perhaps things are not quite as bad and impactful as sentiment is suggesting. On the subject of data, both German factory orders and French PMI data beat expectations, which was positive and strong in light of global trade tensions. But with Chinese and US trade taking the limelight, this data suggests any potential trade frictions between the European Union and the US have been pushed out, with European markets remaining one of the strongest performing asset classes in sterling terms in 2019. The Reserve Bank of India cut its interest rates by an unprecedented 0.35% to 5.4% in order to stimulate the economy and ultimately wages and inflation. We also saw China release inflation data, beating expectations at 2.8% year on year, signalling that the economy is more robust than broader market anticipated. And finally, the UK released its growth data for the second quarter, which saw a contraction of 0.2% quarter on quarter, the first contraction in over 6 years. UK corporates had stockpiled inventories in Q1, which makes the quarter-on-quarter comparison a bit difficult, but with stockpiling ahead of the prior Brexit deadline, and as it was then delayed to October, corporates ran down these inventories in Q2, which has weighed on GDP. With that in mind, an element of a recovery in growth is expected by the market in the third quarter. Now that's all from me this week, and don't forget, if you haven't already, you can also read a more detailed insight into matters affecting the markets in the email.